You're about to hear my conversation with Shah Khan, Senior Vice President, Portfolio Manager, and co lead of Mackenzie's Blue Water Boutique. Today, we'll get Shah's perspective on the momentum fueled rally we've seen in equity markets the last couple of years, Shah's general thoughts on the Canadian economy, as well as specific thoughts on the consumer. And finally, we're going to get into the specifics of the team's buy and sell discipline and why investors should be staying the course despite market volatility. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction and Mackenzie Private Wealth. Today, I'm joined by Shah Khan, Senior Vice President, Portfolio Manager, and co-lead of the Mackenzie Blue Water Boutique. Shah, thank you for joining the podcast today.
Thanks for having me, Rajan. Always great to talk to you.
Of course. Shah, I'm going to kick off our conversation with a question that's been top of mind for me for a little while now. In recent years, there's been a handful of mega cap growth names in the U.S. that have fueled what seems to me to be a momentum-driven rally in equity markets. That's not really your style of growth investing. So I'm just curious, from your seat, how have you viewed this phenomenon?
Yeah, so look, you're absolutely right. Over the past 2 years, we've had significant market concentration, and it's all been driven by the momentum factor, as you mentioned. And that's had implications on relative performance. Reality is, we are currently in one of the most concentrated market environments since the 90s. So if you look 5 years ago, the top 10 names in the S&P, there would have been something like 25% of the benchmark. You would have seen names like the J.P. Morgans, the Berkshires of the world, United Health, J&J. You fast forward today, the top 10 names look quite a bit different. Tesla, Meta, Nvidia went from 1% to 7% of the benchmark. And these are high beta names, right? Which means that the volatility of the market has also gone up. So more concentration, more narrowness, and more market-based risk that's tied to these big names. So it's been a tough environment for active managers like us who run portfolios of high active share. I won't sugarcoat it. As you know, Rajan, we don't chase hypergrowth or crowd into narrow parts of the market just because they're working in the short term. And how do we view this? Well, look, you've had two back-to-back years of very strong market returns, but I think perspective is important because longer term, the US market typically grows earnings around 7% a year. And market returns should track that over the long term. So when you've had 25% plus 2 years in a row driven by a handful of stocks, that kind of performance isn't sustainable, and we would expect markets to broaden out. And we've already seen signs of some normalization. This year, returns have started to broaden out, and we've seen a positive shift. So the headwind that we were contending with, it's been a tailwind to our performance, and that's really where we believe the advantage of our process really comes through. So definitely market concentration on the US side. But one other thing that I think is often missed is it's not just the US, right? We've been contending with market concentration even here in Canada. It's just not on an individual stock basis, but a sector basis. And gold would be the big one, right? And just to put into perspective, year to date, uh, TSX is up 7%. Materials, which is, two-thirds plus gold, is up 30%, right? That's 13% of the index. And as you know, our process philosophy, stylistically, we don't own gold. So again, these are some of the headwinds that we've been contending with over the past few years.
That's so interesting, and it's a great way to frame our conversation. Thank you, Shah. So I'm going to ask an extension of my first question, and it's clear to me already there's some market environments that are probably more conducive to your style than others. So I think this is already the right time for you to walk us through when your approach tends to outperform, and then also when it might lag.
Ultimately, it comes down to the businesses we own, right? So if you look at our portfolio, the businesses that we've compiled. Because these businesses, they're not as economically sensitive, they generally do better than the average in a slowdown or recession. I mean, you're not going to see a collapse in earnings or revenue. And by extension, the fund should do better than the average. So, generally speaking, in a slowdown, in a recession, nobody has a GDP tailwind, right? So, commodities tend to struggle, cyclical companies tend to struggle, growth is scarce. And it's the durable growth businesses that really stand out in this environment, and that's consistent with our style. So that's probably the best environment for us. Now, if I just look at the flip side, we expect to lag in very strong momentum-driven markets, particularly ones that's been led by deep values, cyclicals, commodities, or hypergrowth businesses. That's just not our playbook. So last year's, I think, is a good example. I mean, on an absolute basis, the fund returned 15%, which all else equal, we would have been thrilled because it lines up with the 10, 15% free cash flow growth our businesses generate. But when the market around you is going up 25%, it doesn't look so hot. But look, because we're conservative growth investors, it naturally means there's going to be some environments where we don't look as exciting in the short term. Our focus has been to deliver consistent absolute returns through a cycle while protecting on the downside when markets do get choppy. So we're not going to outperform in every quarter or every type of market environment, but that's a trade-off we're actually quite comfortable with.
Very good. Thank you. Now, I know you're not a thematic investor, Shaw. You're not a macro investor. You don't make these big macro calls, but nevertheless, you are a portfolio manager. So I know you pay attention to the macro. So 2025, we've seen lots of market volatility, often coming out of on again, off again tariff rhetoric or trade war escalation out of the US. I'm just curious, how have you maybe analyzed this situation? And then how have you actually navigated it from a portfolio management perspective?
Yeah, so there's a few parts to this, right? It has been the big macro overhang. The issue has just been the sheer unpredictability of it all, right? I mean, you said it, the on again, off again, back on again. You might have heard of that taco trade, right? Trump always chickens out, where some investors are anticipating market rebounds because of all of this on again, off again policies. It's comical if it wasn't true, right? So the way we look at the direct impacts, the indirect impacts, and then what it means for our portfolio. I mean, from a direct impact perspective, it's quite limited. We generally have a limited exposure to sectors that are extensively tied to US exports or global trade frictions, such as autos, commodities, or heavy manufacturing. And ultimately, just goes back to our process philosophy. I mean, we're gravitating towards service oriented businesses like a Thomson Reuters and Aon. We're gravitating towards businesses that have localized supply chains, domestic revenue exposure. I mean, take Waste Connections, great example. I mean, it's the third largest waste services provider in North America, arguably the best operator in the space, recession resilient. It's completely insulated from tariffs, a long track record of disciplined M&A. You have strong pricing power. And in an uncertain macro backdrop, it really stands out as this idiosyncratic compounder that we have a lot of confidence in. So, I mean, we feel very good about our holdings. Um, we saw very minimal turnover during recent spikes in volatility during the Liberation Week, and that's not by accident, right? It reflects the resilience of our holdings, and it's precisely in these type of environments where we lean into the fundamentals of our businesses to provide that downside protection that we're always talking about. So, not surprisingly, during these tariff-driven sell-offs, our portfolio outperformed meaningfully, and that's kind of consistent with what we would expect. Now, one last thing is just the indirect impacts, and managing money in Canada, which is my focus. Look, the risk is real, right? The exports to the US, it's about a fifth of our GDP. Our economy is deeply intertwined with the US. And I think we're especially vulnerable just given the current backdrop of rising unemployment. We're just under 7% now. You have weakening productivity. You also have the lingering effects of an interest rate shock. So it's just an added headwind to consumer balance sheets. And I think it's the consumers that will ultimately bear the cost of these tariffs. So, it's these indirect impacts that we're watching more closely, and it's kind of what gives us pause on the Canadian consumer generally. That said, look, it's a fluid environment. We're not complacent, and honestly, a single tweet can change everything by the time we're even done this podcast. So, um, we're monitoring the situation, and if any action needs to be taken, we will. But right now, we feel very good about our holdings.
Excellent. Thank you. Now, Shaw, you've not only alluded to, but you've given examples about the types of companies you like to own. You've hinted towards your valuation discipline, but let's flip the script a little bit. What actually gets you to sell a position? And can you give an example that would help bring your sell discipline to life for me and the rest of our audience?
Yeah, I mean, it's a good question, right? I mean, the sell discipline is every bit as important as buy discipline. So there's generally a few reasons why we exit a position. The most important being there's a change in the investment thesis. So if the original reason we bought a business no longer holds, we sell. And at that point, valuation doesn't matter, right? Beyond that, we'll sell if valuation gets stretched beyond what's justified by fundamentals, or if we just see better risk return or risk reward opportunity elsewhere, and we want to reallocate capital. So more high grading of the portfolio. But thesis deterioration, I think that's the biggest one here. And just to give an example, um, TD is a great example of the sell and buy discipline actually. So we bought it late last year. We exited the position back in 2022, right? And it started with what we felt was a leadership problem at the bank. At the end of the day, a business is more than just a compilation of financial statements. It's about people, and a big part of our process is just getting comfortable with the people, their vision, their ability to execute. And at that time, we were seeing signs that poor leadership was starting to erode the culture inside the organization. It was bleeding into employee experience. It was bleeding into customer experience. And then it ultimately led to very poor capital allocation decisions. And then you eventually had the AML issues surface, which frankly shouldn't have been a surprise. It just all pointed to a breakdown in the discipline, in the governance at the bank. So at that point, the thesis was broken. That's why we exited the stock. Um, Now, if I just flip the script a bit, I mean, fast forward to today and what's changed? Well, a lot actually. You have a new CEO, a refreshed leadership, a refreshed board. You have a global resolution to the AML issues. All of the issues that we had that, derail the thesis, they're now in the rearview mirror. The core Canadian franchise is still strong, lots of opportunities for self help. And given trough valuations, we initiated a small position following the market dislocation that happened late last year. So, I mean, that's really the essence of our process. We stay close to the fundamentals, we monitor for positive change, and we act decisively when we see that.
Very good. Now, Shah, I want to stay with the theme of heading for the exit, maybe not in a rush, but nevertheless heading for the exit. Your team made the decision to exit traditional oil and gas back in 2018, and this was based on the view that the space wasn't a long term growth sector any longer. How has that call impacted performance over that period of time as well as recently? And maybe if I can already tie in a follow up question as you think about my initial question, would you ever own energy again?
Yeah. So, our decision to exit in 2018. Well, this year it's been a tailwind to our relative performance, even last year. Um, but look, it's been a headwind in the 2 years prior to that. So energy prices has been volatile, not surprisingly, right? You have two geopolitical conflicts. You have a new administration in the U.S. So we'd expect that volatility to continue. But we're long-term investors, right? And we think that the long-term math just isn't in energy's favor. And frankly, nothing that we've seen has changed that view. If anything, our conviction has just gotten stronger. On the demand side, you're seeing demand flatten out for the developed world. You're seeing China make a huge push into renewables, into EVs. And Sinopec came out and saying that they expect demand to flatten by 2027. That's 2 short years. And then on the supply side, it's a very different picture, right? Trump is openly pushing this drill, baby, drill agenda. OPEC's bringing more production, you're seeing new discoveries. So, given this backdrop where you have slowing demand, rising supply, it's just not a great setup from an investment perspective. Now, to answer your second part of the question, would we ever own it again? Um, Look, never say never. Um, the reason I'm pausing is because I just have a hard time envisioning a scenario where that would hold true. Let me back up for a second. McKinsey Consultants, that's not McKinsey us, but McKinsey Consultants, they estimate that the decarbonization opportunity is about $275 trillion over the next few decades. What you would need to see is these investments unwind on a global scale, right? Not only that, you would have to see global capital pivot back to fossil fuels in a big way. That type of situation seems unlikely, just given that this push towards renewables isn't just driven by environment, it's driven by national security, it's driven by energy independence, and it's driven by economics at the end of the day. Some of these renewables are just cheaper and they're better. So, why wouldn't a country adopt them at mass scale? But if this does happen, it's our responsibility to take a fresh look, and it's our responsibility to constantly test and retest our investment thesis. What's most important is that we would never compromise on our process or philosophy. So the companies would, have to generate that free cash flow growth. They'd have to have the strong balance sheets, and importantly, it would have to be a long-term investment thesis. Like it can't be a quarter two blip. We'd have to be able to formulate a 10-year investment thesis. And at this point, it feels unlikely. On the contrary, like I said earlier, our conviction that the energy transition is going to put this downward pressure on demand structurally, that conviction has only gotten stronger. So we've been focusing a lot of our attention and energy, no pun intended, um, on the energy of tomorrow, right? So businesses like a Schneider Electric, global leader in low medium voltage infrastructure grid intelligence. So they're basically at the center of rethinking what the entire power grid needs to look like when you have EVs, when you have renewable energy, right? The traditional hub and spoke power model um, won't work in the future. You're going to have wind farms, solar farms, you're going to have batteries, you're going to have EVs all on the grid, and they all need to talk to each other in real time, and Schneider is helping enable all of that. So those are the type of businesses we're looking for, um, and we're focused, I would say, more on the energy of tomorrow, just not the kind that gets pulled out of the ground.
Very good, Sean. Now, in your response to my last question, you made reference to having a long-term thesis, your long-term investors. So let's move over to a subject that you and I have had many conversations about in the past, both on the podcast and in person, and that is on AI. We recognize the long-term opportunity within AI, within the artificial intelligence space, but at the same time, sometimes use cases have proved elusive. But we haven't talked about this in a few months. What are you seeing right now in this space, and how are you positioning to benefit if those use cases have arisen?
Yeah, I mean, look, our views on AI has evolved. At the heart of it, I think what hasn't changed is our view that this is absolutely real. We think it's one of the most important technological shifts we've seen in our careers, possibly in our lifetime. But there's still a lot of unknowns. If you look at how it started, it was really this infrastructure led investment cycle, right? You had these hyperscalers, the Amazons, Google, Facebooks of the world, just spending hundreds and hundreds of billions of dollars building out data centers, buying tens of thousands of chips. So you had all of this upfront spending, and this created a surge in demand for companies like NVIDIA. So it naturally raised questions, once we've had as well, about how sustainable that demand really is. I mean, why did NVIDIA drop 17% when DeepSeek was released? Well, it was because their model was developed at a fraction of the cost, and it raised concerns about the durability of demand for these ultra high end, very expensive chips that NVIDIA makes. So, durability of demand was a big question, and it's one we continue to wrestle with. To answer that question, I mean, I think it's worthwhile looking at AI in two parts, right? You have one which is training, and the second is inference. training is basically what happens, in these data centers. And as the name suggests, it's you're basically teaching the models. And that's where a lot of the investments have gone to. Inference is where you take those models and they're actually used to, answer questions or generate content on ChatGPT. So what's changed from our perspective is that we're seeing more and more usage of AI across sectors, across industries. I mean, we can see it in-house at McKinsey. There's been a big push on AI. So what that means is you're seeing the shift in demand from training to inference, and it could keep chip compute demand elevated for some time. But like I started off with, there's a lot of open questions. Like, what are the business models for these new applications? um, how much compute would these inference really require? What type of infrastructure is required to support it at scale? So these are all live questions, and they're going to shape how the space evolves over time. So the opportunity is very real, but so are the risks of capital misallocation. And we think the best way to approach this is by sticking to our process that's always guided us: quality businesses, durable growth tailwinds, and valuation discipline. So maybe just one example, and I've mentioned this to you before, but for our listeners, Thomson Reuters, they're an early beneficiary when it comes to AI, and for them, it comes down to content. In a world driven by AI, content is king. So the models are just as good as the data that they're trained on. And in sensitive areas like law and accounting that Thomson Reuters is in, accuracy isn't optional. So the content is this powerful moat. You combine that with their deep customer relationships, and it's just providing this lift to their growth. And it's not just a nice narrative, right, Roger? It's already showing up in their numbers. You're seeing that lift in their organic growth. And it's also coming with increased profitability, which is very important to us as well.
Great perspective on AI. Shah, I'm going to turn to my last question to wrap up our conversation. We are on the precipice of the second half of 2025, believe it or not. So it's the right time for me to ask, what's your outlook over the course of the rest of the year? What are you thinking about?
Yeah, I mean, look, there's always in this business, there's always a wall of worry. There's always this longer list of issues we're watching, and this year is shaping up to be no different, right? The two big things we're watching are Trump and tariffs, which we've already discussed, and from my perspective, also the Canadian consumer, particularly around the mortgage renewal cycle. So maybe just a little bit of color on that. When it comes to the Canadian consumer, right, we're contending with higher unemployment, rising debt levels. You have the effects of an interest rate shock that's still working its way through the system, particularly as it relates to mortgages. And then you layer on top of that all the tariff uncertainty, and it seems like the Canadian consumer is in a tough spot. Now, on mortgages, our view has kind of evolved over the past year. So, very briefly, I think compared to a year ago, we actually feel more comfortable that consumers, and by extension, the banks, would manage through this risk quite well. And there's a few reasons for that. First, interest rates coming down. I mean, people aren't going to be renewing at 6, 7% anymore. That helps. Um, and if needed, regulators still have levers to pull. You can increase amortization period, which they've done for some buyers, and a good rule of thumb I like to use is you add 5 years to your amortization period, and that's equivalent to 75, 80 basis points of rate cuts. So that helps as well. But one data point that I personally watch very closely over the past several quarters is just the negative amortizing mortgages at the big banks. So these are basically mortgages where the monthly payments, they're not covering the interest. So in theory, they're never going to get paid off. These balances, they've dropped off significantly. I mean, at the peak, it was around 130 billion. Last quarter, the banks just reported they're at 2 billion, right? So it's much, much more manageable now. And we don't see mortgages as the systemic risk for the banks or broader economy. But I think they're going to cause other problems. We're seeing signs of stress emerge in unsecured credit, credit cards, personal lines of credit, autos. No red flags as such, but loan losses are certainly on the rise. And just given that more and more income is going to service debt, it means less available for spending. And that's not really a 1 or 2 quarter blip. I think that's just going to be this continued constraint on consumer demand. Now, I don't want to sound too ominous here, right? Reality is that the Canadian consumer has actually fared much better. They've been much more resilient than certainly I was expecting. And the weakness in the macro data, you've yet to see it in the company results, in the bank results in any meaningful way. Consumers are sitting on abundance of cash. It was built up through COVID. Employment was strong. Wage growth was strong. But at the same time, with all of these headwinds, I don't think we're out of the woods yet. And I am quite cautiously positioned when it comes to the Canadian consumer. So the other thing to keep in mind is there's always going to be opportunities, even in the Canadian consumer space, right? So on the consumer side, businesses focused on essentials, businesses like a Dollarama or Loblaws that are benefiting from all the trading down, more value conscious consumers, businesses like a Pet Value, where spending on pets is structurally less cyclical than the overall market because they're benefiting from trends like premiumization, humanization. So there's always going to be pockets of opportunity, and and it's our job to find those opportunities despite all the noise that's happening. So look, I mean, we've compiled a great roster of durable growth businesses, and we feel great about the businesses we own, and the companies are performing in line or better than expectations. And over time, it's going to be the fundamentals of these businesses that drive compounding of the portfolio. And it's the fundamentals of these businesses that provide the downside protection that we and investors care so much about. So that's what we're here to do, deliver consistent absolute returns through a cycle, protect capital when markets get choppy. And that's what investors can continue to expect from us.
Great perspectives, Shah, both on my last questions specific to what you're seeing or thinking for the second half of the year, as well as our entire conversation. I'm looking at the time here. I see that our time together has come to an end. I want to thank you for joining the podcast, and I'm already looking forward to the next time we'll have you on.
Appreciate your time, Rajan. It was great chatting.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.